Good afternoon. My name is Naoki Sunamoto, Director of Fukoku Mutual Life, Japan. Today, I talk about a study on regime shift of stock market during the pandemic. This presentation comprises 3 sections and aims to review the impact of the pandemic's onset on global stock market via volatility indices and index changes, and identify 4 typical regimes, examine the behavior of the Japanese stock market, and group the sectors into 4 categories, and present a case study of hedging strategy and consider restructuring the portfolio when the strategic stock holding during the pandemic. Section 1. First, we look at volatility indices at the onset of the pandemic. On 24th February 2020, the WHO stated that we must focus on containment while doing everything we can prepare for a potential pandemic. The volatility indices jumped about 20%, signaling investors expected higher volatility than usual. On 11th March 2020, the WHO stated that we have assessed that COVID-19 can be characterized as a pandemic. The volatility indices recorded their highest level since the global financial crisis. At the onset of the pandemic, the correlation coefficients became almost 100% immediately. In December 2020, when vaccination started in Europe, the UK, and the United States, but had not yet begun in Japan, the correlation coefficient declined sharply. Next, we look at index changes at the onset of the pandemic. The volatility index is calculated based on swap rate fluctuation for the coming 30 days. Investors also look to past performance to inform their decision-making. Thus, here we look at the sample means, sample standard deviations, and correlation coefficients based on the moving past 30 days changes in stock indices. The observation period concludes at the end of December 2020, when vaccination started in the UK, the United States, and Europe. We see a sharp decline in each at the onset of the pandemic. After bottoming out, recovery commenced for each index, but at different speeds. S&P was the first to recover, followed by topics and stocks. The figure shows the stock indices sample mean, return, and sample standard deviation, risk. We find that the lowest returns were followed by the most heightened risks. The latter reached 6 in Japan, 8 in Europe, or 11 in the United States, times normal at the midpoint of market turmoil. The figure shows the risk-return orbits from which we can identify 4 typical regimes. The first regime is turmoil. From late February 2020 to mid-March 2020, returns decline and risk hikes. The second regime is bottoming. From mid-March to early April, returns start to recover, but risk continues to grow. The third regime is recovery. From early April to early May, returns continue to increase and risk reduces. The fourth regime is stability. From early May to late August 2020, both return and risk become stable. Let us look at those regimes by animation. You can see the 3 dots representing the risk return of the stock market move to correlate. Enjoy. I like it. Wait a moment. Finished. In fact, the correlation coefficients between stock indices hiked to around 19% after the 24th February WHO statement and remained at that level by the end of the stability regime. The figure shows the correlation coefficients between equity risks. Almost 100% coefficients were observed during those 4 regimes. Section 2. Topics comprises 33 sectors. In the following, we differentiate by sector by color. First, we review the Japanese stock market comprehensively. At the end of December, the indices of the specific sectors had recovered to above 100% of initial values. However, more than half of the sectors remained underwater. Mining and air transportation hardly recovered, which implies that the specific sectors drove the recovery of topics. The risk hiked sharply in mining, marine transportation, and air transportation from March to April and remained higher than in other sectors during the year. The shapes of other sectors express those three resemble topics. Looking at the risk-return orbits, we can identify the four regimes mentioned above in varying degrees. Still, mining, marine transportation, and air transportation show significant distortions. We can recognize the turmoil, the bottoming, the recovery, and the stability. Let us look at those regimes by animation. You can see the 34 dots representing the risk return of topics and 33 sectors moving to correlate. Enjoy again. I love it. When you look at the correlation coefficients with topics, some sectors show low correlation coefficients. It implies that recovery may differ by the industry from the whole market. In fact, when we look at the sector indices on 16th March 2020 and subsequent changes, we can recognize that the sectors showing excellent resistance do not always recover faster, and the sectors showing steady growth in recovery were not always excellent in resistance or faster recovery. Thus, analysis from each perspective of resistance, recovery, and steady growth is appropriate when we observing the index by sector. Next, we review the sectors with highest weight in topics. Look at the industries when the 10 highest weights in topics, which together account for about 70%. It implies that the recovery of topics heavily depends on those industries. Note that banks, seriously affected by economic downturn due to the pandemic, fell to 10. The leading sector indices outperform the aggregate, except for transportation equipment, banks, and wholesale trade. Among the risk paths, transportation equipment offered an elevated path compared with other leading sectors, indicating that the industry was most vulnerable to the pandemic in that group. And looking at the return paths, they almost overlap with the full market. Both service and banks go around the outmost orbits during the bottoming regime, but show different paths afterwards, which contributes to the difference in index growth towards the end of the year. Both pharmaceutical and information and communication sectors show quicker recovery than the others, and subsequently less correlate with the aggregate. Next, we group the sectors into 4 categories. In categorizing the sectors, we consider a concept of resilience, the ability to adapt to change backed by resistance and recovery in line with the definition of Hamel and Longstaff. We shall evaluate the resistance by the decline in value at the onset of the pandemic, the recovery by the average return during the recovery process, and the ability to adapt to change by its risk-return efficiency, respectively. The figure shows the index on 16th March 2020 and the average return from 60th March to 30th December, indicating the degree of resistance and growth. The figure shows the standard deviation and the average return during the period, indicating the steadiness of growth. Using those figures, we categorize sectors by the index on 60th March and the average return from 60th March to 30th December, and adjust it such that sectors indicating similar risk-return characteristics are in the same group. According to the methodology, we categorized the sectors into 4 groups from the view of resilience. Group A has a trough almost equal or shallower than topics, recovers quicker than topics, and grows steadily. Group B has a trough slightly shallower than topics, but exhibits a similar recovery pattern. Group C has a trough similar to topics and recovers more slowly and to a lesser degree than topics. Group D has a trough deeper than topics and does not recover. Then we look at each group explaining representative sectors. First, Group A sectors. Information and communication, which had been growing before the pandemic due to the digital transformation in various fields, showed significant growth towards the end of the year due to the strong demand for remote working. Other products, typically the gaming industry and precision instruments, benefited respectively from the strong demand that emerged by staying home and the increased need for medical equipment. Risk return shows that many lines overlap with topics. Risk return orbits almost indicates the orbits drawn near topics. Group A and whole market affect each other and exhibit similar risk return characteristics. The sectors with remarkably recovery attribute correlate less with topics, indicating good diversifiers from overall market exposure. In summary, Group A is a group that successfully grew by adapting the business, taking advantage of the increased demand, and consequently had led the recovery of the whole market. Second, Group B sectors. Pharmaceutical was positively affected by the pandemic initially, but the effect was gradually offset by a decrease in demands due to refraining from visiting medical facilities for fear of infection, resulting in a stall in the recovery. Forest sales trades commodities, materials, or resources essential for our society. The sector was affected by the decline in resource prices due to the economic downturn, resulting in a slower recovery than the fall. Risk return shows that risk stays higher than the fall in many sectors. As a result, risk return orbits shows the skewed orbits outside of topics. The figure shows low correlation with topics, which implies that Group B recovers differently from the fall. In summary, Group B is a group that had good resistance to the pandemic, but recovery was less pronounced as there was no pandemic-driven advantage. Third, Group C sectors. Transportation equipment, typically the automotive industry, depends on the industries supplying the parts. In Group C, glass and ceramic products, metal products, non-ferrous metals, and rubber products are closely related to the parts. As automobiles are produced just in time and have no spare capacity for parts, supply production stopped once, some components became short, and orders for other parts were also suspended, delaying the recovery of automotive-related industries. Risk return shows all risks are higher and decrease slower than topics. As a result, risk return orbits indicates largely skewed orbits outside topics. The figure shows highest correlation coefficient in all sectors, indicating that the group's recovery depends on the whole market. In summary, Group C is a group that was fragile during the pandemic and recovered slower than the whole, as there were few associated advantages. The recovery of this group depends on the whole market. Finally, Group D sectors. The air transportation sector shrunk due to the significant decline in demand as a result of domestic and international travel restrictions. Iron and steel stagnated mainly due to the decrease in automobile production. Oil and coal products and mining were impacted by the turmoil in the crude oil market. Marine transportation initially faced confusion and stagnation, but dramatically recovered towards the end of the year. Immediately after the shortage of labor and container was resolved, the sector quickly recovered, boosted by the increased demand due to stay-at-home orders. Risk return shows that the risk hiked sharply in mining, marine transportation, and air transportation from March to April and remained high during the year. Risk return orbits indicate significant distortions in those sectors. The figure shows confusion and stagnation in the industries. In summary, Group D, with one exception, is a group that was most adversely affected by the pandemic, and the recovery was hampered by its heavy dependency on infection prevention measures and crude oil prices. The external restrictions had severe consequences. Section 3. We consider the case a life insurance company holds stocks strategically from a long-term perspective. If the company wants to hold such stocks, even in a turmoil market, a collar strategy is one of the best hedging strategies. The collar hedging comprises a long position in the underlying stocks, a long put option to hedge the downside risk on the stock, and short call option to finance the put purchase. The figure shows the payoff of collar hedging. The strategy has the great advantage of hedging downside risk cost-effectively, allowing upside potential. Assuming we have weathered the initial market turmoil with the collar hedging in place, we shall now restructure the portfolio, stock portfolio. First, we take a case holding air transportation, poorly resilient to the pandemic. The sector shows a low correlation with Group A, which has excellent resilience. Thus, we shall proceed to restructure the portfolio by combining electrical appliance, machinery, other products, retail trade, information and communication, and air transportation. We derive the figures based on the past 60 days as of 15th September 2020. Assuming the company can take additional equity risk as much as that of air transportation, we set a target of maximizing the portfolio's market value at the end of December. To proceed with the calculation, we need to convert the log normal number to the sector index value at the end of December, i.e., the value 72 days ahead from 15 September 2020. Then we derived the figures. To identify the optimal portfolio, we plot an efficient frontier curve of various portfolios. As a constraint, we set weights such that the aggregate risk of portfolio be within 2 times that of holding the air transportation sector alone, and find the intercept with the maximum slot, i.e., the highest Sharpe ratio. The identified optimal portfolio is expected to be more resilient to intermittent wave of infection. The total weight became 1.2 times of holding the air transportation sector alone. As a result, the company can earn 84.8 from the restructured portfolio, which is 4 times when the company passively holds air transportation alone. The risk increased, but can be reduced to within 2 times as much due to the diversification effect. The restructured portfolio excels in mitigating the downside risk. Indeed, the portfolio produces capital gain despite the loss from air transportation. Conclusion. By examining the market behavior during the crisis, we saw many industries react passively to the crisis and delay their recovery. On the other hand, we saw some industries adapted to new circumstances, were successful and grew remarkably in that period. It provides valuable insight for informing insurers' actions in the next pandemic. We conclude that looking back and examining what happened during the crisis is essential to prepare for the next crisis, and lessons learned must be leveraged in next pandemic. In the end, I thank Chris Howell, Annie Tai, and Yuki Sakurai for peer reviewing the paper and providing insights. And I thank my excellent staff for helping to collect data and check the outcomes. And come to Tokyo next ICA. And please join the AFIA ERM section of IAA and share your insights. Thank you for attention. Thank you very much.
Naoki, for that very insightful presentation. We have a few minutes available for questions, so if there are any questions from the room, I don't know if anyone has tried to post the questions on the app. I'm not getting anything through on the moderated tool, but I think we believe we can take some questions from the floor.
In the last paragraph, you say, get ready for the next pandemic. So when will the next pandemic be? Any good insights?
Next pandemic? We are very afraid of that. But we had to prepare the bird flu type pandemic. So we have much experience about the pandemic. We can do that. It's my opinion. Is that answer? Okay? Does that make sense? Thank you.
Sorry, I'd like to ask you one very primitive question.
Yeah.
So you have classified 4 categories.
Mm-hmm.
How do you classify 4 categories? By utilizing some statistical method?
Yes.
Yeah, please.
Okay. Please read my full paper. It's very informative. And page 38. First, I categorize by resistance and recovery, and then we group by risk return efficiency. 4 is good for me. Don't ask why 4. Many evaluations will be possible. In fact, in the EU, did similar analysis about the stock market. They analyze more detail and categorize more than 4 groups. For example, 7 or 8, I remember. So many ways is possible, I think. Is that right? Okay? Mm-hmm.
Hi, great presentation. Enjoyed the visual graphics. Just had a question around how you would approach macroeconomic risks, especially in Japan, given currency swings, given that the Bank of Japan took quite a adverse...
as we already know, we suffer from very low interest rate environment. So life insurers have stock in their asset. So we have to manage during the pandemic. So it's one of the ideas, color hedging, and restructure our portfolio.
Yeah, and
because we cannot sell the stock easily. We have strong relation with some stock some stock industries.
right.
So strategically we hold, so we have to stand.
So you would adopt like some currency hedge as well?
Currency?
Currency hedge, yeah.
Currency is another risk. I talk today is about the Japanese stock market.
Yeah, yeah.
We don't mind currency risk.
Investing internationally, but yeah.
Yeah. Thank you.
That's all I had. Thank you.
Thank you very much. I think that's unfortunately all questions that we have time for now, but I just want to remind you that after the third presentation, there will be an opportunity to ask more questions, even for our first presenter. So thank you very much, Naoki.
Thank you.
Thank you.